good day traders, Chris Weston here, Head of Research at Pepperstone. For a while now we've been fairly bullish on global equity markets, and that continues to be the case. If we look at the backdrop behind the global equity rally, central banks continue to have the markets back. The market feels comfortable with the way that central banks have been portraying their view of targeting easy financial conditions. But if we have a look at some of the other trigger points that we've been looking at for equity appreciation, 5-year real yields have got absolutely decimated through December into the end of Q1. We saw the 5-year real yield, or the inflation-adjusted yield, going from 116 down to around 38 basis points. Okay, it's moved up a little bit of late, and that is a bit of a concern for me, but not to levels where we're really going to be starting to thinking about shorting markets at this level. But we're looking very much at inflation-adjusted yields. We know the equity market loves lower real yields. It extenuates the cash flows. It makes them, those businesses much more attractive from that perspective. It makes the earnings yield and the dividend yield far more attractive as well. So we are watching the fact that bond yields have started to move up a little bit, both on the nominal and the real side. But at the moment, we're not really at levels that we're genuinely concerned about. We love the fact that inflation expectations, US 5-year forward rates, which is the market's rate on inflation going forward, sits around 2%. That's an absolutely perfect level for equity appreciation. It's not too hot, it's not too cold. It's at a level where central banks do not have to act in any shape or form. So inflation expectations are at levels where further appreciation in equity is very much there. We love the oil price at $62. I think the fact is this a supply issue? Is it a reflection of better improvements in global economics? Most people suspect this is probably down to the supply side, but higher oil price is very, very good for equity appreciation as well. So we're wanting to see that continue pushing up at the moment. At the moment, oil prices are very much under the radar, and we think there's possible juice to see this going up to $65, although it is a slight climb going forward as well. We love the fact that implied volatility in the S&P is around 14%. It's still at very low levels. It's not troubling some of these guys who have to target volatility to understand where this is going to go. If high volatility is in the market, a lot of these funds will take equity out, they'll go to cash, and the implied volatility in the market will dictate their cash positions going forward. So all of these factors are very much still very much prevalent to see equity appreciation. Economics have started to improve. We've seen that in China with their PMI series, both on the NBS numbers but also in the Taishan numbers. We've started to see European data starting to show signs of green shoots. We saw that in the composite numbers overnight. We've been seeing the IFO numbers in Germany start to see a modest rebound as well, although it still takes some work going forward. The data in the US is mixed. Some of it's good, some of it's bad, but it doesn't necessarily suggest that we're going to see too much of a move there. And we're also keeping our eye firmly on what's happening between the US and Sino relations, where, okay, fine, a lot of it is in the price. We've been hearing progress for many months, but my view is if we do see President Xi and President Trump showing a great solidarity between the two, and we actually see a certain unity, which most people don't expect, married with a full reversal of the trade tariffs, that's not in the price, and I think that could take the S&P to new all-time highs. So if we have a look at the global markets, I still like the DAX. If you have a look at the market there, it's breaking out. I think the Euro CNH cross is really a very key barometer there. If the CNH or the Chinese yuan continues to appreciate, it gives the Chinese importers purchasing power over some of those German and European export companies. I think so if Euro, CNH or CNY, the renminbi there continues to fall, then I think that will benefit the DAX. So I quite like the DAX. In Germany, I think the market continues to be very much underweight that market as well. The S&P, I do believe that we'll probably go on to see new all-time highs. But one thing we are concerned about, and I think one of the things we do need to talk about, is the idea of interest rate pricing. If you go into what's priced between June this year and into 2020 of December, you can see interest rate cuts are being priced out of markets. Better economics, slightly better economics, and better market conditions have seen rate cuts being priced out of the markets. The question that we're asking here is if the rate cuts markets continue to reprice, bond yields on a real basis continues to move higher, what level will start troubling equity investors that they start taking some of these positions off the table. So I'm looking at rates, I'm looking at bond yields as my proxy. At the moment, we're still long risk, we're still long equities, certainly in Europe, certainly in China, and also in the US as well. But we still like Australian equities here as well.